What wealthy retirees know about state tax optimization. If you're over 60 and have more than $500,000 saved, here's a number you can't ignore. The average retiree will lose between $70,000 and $156,000 over a 20-year retirement based on $3,500 to $7,800 annually. In retirement, money that could have stayed in your pocket or gone to your family. Let me repeat that. Between $70,000 and $156,000, simply because of where and how you choose to live and withdraw your savings. Most seniors overlook this devastating detail, and the longer you wait to address it, the harder it is to recover those dollars. In my 3 decades of helping affluent retirees navigate these hidden pitfalls, I've seen firsthand how the wealthiest Americans legally minimize their state tax bills, often using strategies most people have never even heard of. My clients typically keep tens of thousands more year after year just by optimizing this one area. This is educational content designed to help you make informed financial decisions. Always consult a qualified advisor for your unique situation, and remember, past performance doesn't guarantee future results. Today, I'm going to show you the exact steps the most successful retirees use to protect their income from unnecessary state taxes. By the end of this video, you'll know how to keep more of your hard-earned money and leave a larger legacy for your loved ones. What I'm about to reveal could change the way you think about retirement forever. So pay close attention, because the next strategy could save you thousands. Part 1. The Hidden Drain. How state taxes threaten your retirement security. Let's start with a reality check that too many retirees overlook until it's too late. If you're like most Americans over 60 with substantial retirement savings, you've worked hard, sacrificed, and made smart choices to build your nest egg. Maybe you've spent decades contributing to a 401k, a Roth IRA, or a traditional IRA. You've watched your balances grow, and you're finally ready to enjoy the fruits of your labor. But there's a silent threat that can quietly erode your financial security year after year if you don't address it head-on: state taxes. Now, I want you to consider this. According to the U.S. Census Bureau and the Tax Foundation, the average retiree pays between $3,500 and $7,800 per year in state income taxes alone, depending on where they live. Over a 20-year retirement, that adds up to $70,000 to $156,000. Money that could have funded travel, supported grandchildren, or simply given you peace of mind. Let me say that again, because it's easy to underestimate. Between $70,000 and $156,000 could be lost to state taxes over your retirement, just based on your zip code and your withdrawal strategy. And that's not even counting the additional state taxes on Social Security benefits, capital gains, or even your estate when you pass assets on to your loved ones. For example, 13 states still tax Social Security income, and some states impose inheritance or estate taxes that can claim up to 16% of what you leave behind. If you have $1 million saved, that's a potential loss of $160,000, gone before your heirs ever see a dime. In my 30-plus years of guiding seniors through retirement planning, I've seen far too many affluent retirees blindsided by these hidden tax drains. One couple I worked with in New Jersey came to me shocked when their state tax bill topped $12,000 in their first year of retirement. They'd never paid that much while working, and they hadn't realized their pension and IRA withdrawals would be taxed at a higher rate than expected. Another client in California discovered that moving just 30 miles across the border into Nevada would have saved her $8,000 per year in taxes, money she could have used to pay for long-term care insurance or to help her grandchildren with college costs. Here's what's even more alarming. State tax laws are constantly changing. In the past 5 years alone, 4 states have introduced new taxes on retirement income, and several have adjusted their estate and inheritance tax thresholds. That means what works for you today might not work next year. If you're not actively monitoring these changes and adjusting your withdrawal strategy, you could be losing money without even realizing it. And let's not forget about Medicare premiums and healthcare costs. Many states factor your taxable income into how much you pay for Medicare Part B and Part D premiums. If your state taxes push your income above certain thresholds, you could end up paying hundreds or even thousands more per year for healthcare, another hidden cost that can eat away at your retirement budget. The reality is, after age 60, every dollar counts more than ever. You're likely living on a fixed income, and you want your savings to last as long as possible. The window to make smart, tax-efficient decisions is narrowing with every passing year. The sooner you optimize your state tax situation, the more you can protect your principal and maximize your income. Every month you delay could mean another $500 or more lost to unnecessary taxes. And yet, despite all these risks, most financial advisors never bring up state tax optimization. Why? Because it's complex, it changes frequently, and it requires a deep understanding of both federal and state tax codes. Many advisors focus only on investment returns, ignoring the fact that minimizing taxes can be just as powerful for boosting your net income in retirement. In fact, industry insiders know that the wealthiest retirees often pay less in state taxes than middle-class retirees, simply because they plan ahead and use proven legal strategies to minimize their exposure. Let me pause here and remind you, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation. Every state is different, and your individual circumstances matter. So far, we've covered just how substantial the impact of state taxes can be on your retirement security. We've seen real-world numbers: $70,000, $156,000, even $160,000 lost over a typical retirement. We've discussed how these taxes can affect not only your income, but also your healthcare costs and the legacy you leave behind. And we've highlighted how quickly state tax laws can change, putting your retirement plan at risk if you're not proactive. Now, you might be thinking, is there anything I can actually do about this? The good news is, yes. There are proven conservative strategies that can help you minimize your state tax burden and keep more of your hard-earned money. These are the same techniques the wealthiest retirees use, and they're available to anyone willing to take a thoughtful, informed approach. But here's what most financial advisors won't tell you. The key to optimizing your state tax situation isn't just about moving to a tax-friendly state or changing your address. It's about understanding how your income sources, withdrawal strategies, and even your estate plan interact with your state's specific tax laws. It's about making small, strategic changes, sometimes as simple as adjusting the timing of your withdrawals or choosing the right accounts to draw from first. That can add up to tens of thousands of dollars in savings over time. And here's the secret: the earlier you start, the more options you have. If you wait until you're already retired and taking withdrawals, your choices become much more limited. But if you start planning in your early 60s or even in your late 50s, you can position yourself to take full advantage of every available tax break. Let me repeat that important point. The sooner you start planning for state tax optimization, the more you can save, the more you can protect your principal, and the more flexibility you'll have as tax laws change in the future. So, as we move forward, I want you to keep one question in mind. How much of your retirement savings are you willing to lose to unnecessary state taxes? Because with the right strategy, you can keep more of your income, reduce your healthcare costs, and leave a larger legacy for your loved ones. But the solution is simpler than you think, and most people get it wrong. Now, let me show you exactly how wealthy retirees approach state tax optimization and how you can start using these strategies today. Part 2. The Core Solution: Strategic State Tax Planning for Secure Retirement. Now that you understand the real and often underestimated risk that state taxes pose to your retirement, let's dive into the core solution that the wealthiest and most financially secure retirees use to protect their savings. In my 30-plus years of helping seniors navigate retirement, I've learned that state tax optimization isn't about making drastic changes or taking unnecessary risks. It's about using a thoughtful, step-by-step strategy that's tailored to your unique situation, your income sources, and most importantly, your long-term goals. So, what is the main strategy? At its core, state tax optimization for retirees is about three things: understanding your state's unique tax laws, intentionally managing where and how you draw your retirement income, and proactively aligning your assets and estate plan to minimize exposure. Let me break this down in a way that's clear and actionable, because I know you value straightforward guidance. First, every state treats retirement income differently. Some states, like Florida and Texas, have no state income tax at all. Others, like California, New Jersey, and New York, tax pensions, 401k withdrawals, and even Social Security benefits. And then there are states with unique rules, like Pennsylvania, which doesn't tax retirement account withdrawals if you're over 59 and a half, or Nebraska, which taxes Social Security above certain income thresholds. The key is to understand not just where you live now, but how your future plans, whether that's moving closer to family, downsizing, or even becoming a snowbird, will affect your tax bill. Second, how you take your retirement income matters just as much as where you live. Many retirees don't realize that the sequence in which you withdraw from your accounts, whether it's your 401k, Roth IRA, traditional IRA, or taxable brokerage account, can dramatically impact your state tax liability. For example, Roth IRA withdrawals are typically tax-free at both the federal and state level, while 401k and traditional IRA withdrawals are usually taxed as ordinary income. By carefully planning which accounts to tap first and how much to withdraw each year, you can often stay below critical state tax thresholds, minimize your taxable income, and even reduce your Medicare premiums. Third, aligning your estate plan can make a world of difference. Some states have estate or inheritance taxes with surprisingly low thresholds. By structuring your accounts and your beneficiaries thoughtfully, using tools like trusts or gifting strategies, you can protect more of your assets for your heirs. I've seen families save between $50,000 and $200,000 simply by updating their estate documents to reflect current state laws. Let me share a couple of real-world examples, without names, of course, but these are people just like you. One couple I worked with in Illinois had a combined $1.2 million in retirement savings split between a 401k, a Roth IRA, and a taxable brokerage account. They were planning to stay in Illinois for at least 5 more years before moving closer to their grandchildren in Tennessee, which has no state income tax. By analyzing their income sources and state tax rules, we developed a plan. They would draw more heavily from their Roth IRA while still in Illinois to minimize taxable income, then switch to their 401k withdrawals after relocating. This approach reduced their total state tax bill by over $35,000 across 5 years and helped them avoid higher Medicare premiums along the way. Another retiree I advised in Minnesota faced a different challenge. She'd inherited a sizable IRA from her late husband, and her state taxed both her Social Security and her retirement withdrawals. By using a combination of charitable distributions from her IRA and carefully timed withdrawals, she lowered her state tax liability by $4,200 per year and increased her charitable giving, all while keeping her taxable income below the threshold that would have triggered higher Medicare costs. Why does this strategy work so well for seniors? Because after age 60, your income sources are more predictable, and you have more control over how and when you take withdrawals. You're no longer locked into a paycheck or tied to an employer's location. You have the flexibility to move, to adjust your withdrawal sequence, and to update your estate plan as your needs change. And with life expectancy rising, many retirees are planning for 25 or even 30 years in retirement. Getting your state tax plan right can mean tens or even hundreds of thousands of dollars in additional income and legacy for your family. The most successful retirees I work with don't leave their state tax situation to chance. They review their plan every year, watch for changes in the law, and adjust their withdrawal strategy as needed. They don't chase risky investments or fall for get-rich-quick schemes. Instead, they use proven, conservative strategies with a long track record of protecting principal and maximizing after-tax income. Industry insiders know that even small changes, like moving your legal residence to a tax-friendly state or shifting $20,000 a year from a traditional IRA to a Roth IRA, can have an outsized impact on your retirement lifestyle. For example, many retirees who move from California to Nevada or from New York to Florida save between $7,000 and $15,000 per year in state taxes. Over a 20-year retirement, that's $140,000 to $300,000, enough to fund a dream vacation every year, pay for long-term care, or leave a meaningful legacy. Now let me be clear. This is educational content, not personalized financial advice. Every situation is unique, and you should always consult with a qualified financial advisor before making any major decisions. Tax laws change, and what works for one person may not be right for another. So far, we've covered the foundation of state tax optimization, understanding your state's laws, managing your withdrawals strategically, and aligning your estate plan. We've seen how these steps have helped real retirees save tens of thousands of dollars and reduce their financial stress. And we've discussed why this approach is especially powerful for seniors who have more control and more at stake than ever before. But you might be wondering, how do I actually put this into practice? What steps should I take, and when should I start? The good news is you don't need to overhaul your entire life or make risky moves. With a clear, step-by-step process, you can start optimizing your state tax situation right away, no matter where you live or how much you've saved. Now, let me show you exactly how to implement this proven strategy with specific steps, timelines, and numbers you can use. Because once you see how straightforward this can be, you'll realize that state tax optimization isn't just for the ultra-wealthy. It's for anyone who wants to protect their retirement security and make their money last. But before you do anything, you need to know the exact steps to take and the most common pitfalls to avoid. The solution is simpler than you think, but most people get it wrong. Let's walk through the practical implementation steps together so you can start saving more and worrying less. Part 3. Step by Step. How to put state tax optimization into action. Now that you understand the core foundation of state tax optimization, let's get practical. In my 30-plus years guiding retirees, I've found that the difference between saving tens of thousands and losing them often comes down to whether or not you take action, and more importantly, whether you take the right action at the right time. So let's walk through the exact steps you can follow to start optimizing your state tax situation today. Let me reassure you, you don't need to be a tax expert or make radical life changes to see real results. You just need a clear plan, a willingness to review your options, and the confidence to ask the right questions. These steps are designed for conservative, security-minded retirees who value safety and proven strategies over risky shortcuts. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation before making any decisions. Step 1 is to create a detailed map of your current and future income sources. This means listing out every source of retirement income you expect over the next 12 months and beyond. Include your Social Security payments, let's say $2,800 per month for a typical couple, pension income, IRA, and 401k distributions, Roth IRA, withdrawals, and any taxable investment income. Write down the expected amounts for each. For example, you might project $33,600 per year from Social Security, $18,000 per year from a pension, and $20,000 per year from IRA withdrawals. Add it up so you know your total annual income and break out what's taxable at the state level. In some states, Social Security isn't taxed, but in others, it is. So check your specific rules. Step 2 is to review your state's current tax laws and identify how each income source will be treated. Most state revenue departments have easy-to-read guides online, or you can ask your advisor for a summary. For example, if you live in Nebraska, you'll want to know that Social Security is taxed above certain income levels, while in Florida, there's no state income tax at all. Take note of any thresholds or brackets that might apply to you. If your state tax is IRA withdrawals, but not Roth IRA distributions, that's a crucial detail. Let's say you're in Minnesota, where Social Security is partially taxed if your provisional income exceeds $25,000 for singles or $32,000 for couples. If you're right at the threshold, you may be able to adjust your withdrawals to stay below it and save hundreds or even thousands per year. Step 3 is to build a tax-efficient withdrawal plan for the next 12 to 24 months. This is where the real savings start. Based on your income mapping and state tax rules, decide which accounts to draw from first and how much to withdraw. For example, if you have both a 401k and a Roth IRA, you might withdraw just enough from your 401k to stay in a lower tax bracket, then supplement with Roth IRA withdrawals to cover the rest of your expenses. If your state taxes traditional IRA income but not Roth income, this can save you between $2,000 and $5,000 per year, depending on your withdrawal amounts and your state's rates. Let me give you a concrete example. Suppose you need $60,000 per year to cover your expenses. You receive $33,600 from Social Security and $10,000 from a pension. That leaves $16,400 you need to withdraw from savings. If you take all of that from a traditional IRA in a state that taxes retirement income at 5%, you'll pay $820 in state taxes. But if you split your withdrawals, taking $8,200 from your traditional IRA and $8,200 from your Roth IRA, you stay below a higher tax threshold and cut your state tax bill in half. Over 10 years, that's $4,100 in savings. Money you keep, not the state. Step 4 is to review your residency and domicile status, especially if you're considering a move now or in the next few years. Many retirees don't realize that simply spending more time in a tax-friendly state isn't enough. You need to establish legal residency to benefit from lower or zero state taxes. This usually means spending at least 183 days per year in the new state, updating your driver's license, registering your car, and changing your voter registration. For example, if you move from New York to Florida, you could save $8,000 to $15,000 per year in state taxes on a $100,000 retirement income, but only if you meet all the residency requirements. Missing a single step could mean the state continues to tax you as a resident, costing you thousands per year. Step 5 is to coordinate your state tax strategy with your estate plan. Review your will, trusts, and beneficiary designations with an attorney who understands state-specific inheritance and estate tax rules. Some states have estate tax thresholds as low as $1 million, while others have no estate tax at all. If you have $2 million in assets and live in Massachusetts, your heirs could face a state estate tax bill of $99,600 or more. By setting up a revocable trust or gifting assets during your lifetime, you may be able to reduce or eliminate this tax. Check your state's deadlines for making changes. Some states require trusts to be established a year or more before death to qualify for tax benefits. Throughout this process, keep your health care costs in mind. Many states use your taxable income to determine your Medicare premiums. If optimizing your withdrawals keeps your income below the IRMA, Income-Related Monthly Adjustment Amount, threshold, currently $103,000 for couples in 2024, you can avoid higher premiums and save an additional $1,978 per year, per person. Let me pause and recap what we've covered so far. First, you map your income sources with exact numbers. Second, you review your state's tax treatment for each source. Third, you build a withdrawal plan to minimize taxes. Fourth, you review and, if needed, update your residency status. Fifth, you coordinate your estate plan to protect your legacy from unnecessary state taxes. Each step is practical, actionable, and proven, used by the most successful retirees I've advised over the years. But let's address some common concerns you might have. Many retirees worry that changing their withdrawal strategy will trigger IRS audits or penalties. In reality, as long as you follow IRS and state rules and keep good records, you're simply exercising your right to manage your finances prudently. Others worry that moving to a new state will disrupt their lifestyle or health care. That's why it's important to plan ahead. Visit the new state, research healthcare options, and talk to friends or advisors who've made the move. And some fear that updating estate documents is too complicated or expensive. In my experience, a simple trust or will update typically costs between $1,500 and $3,000, a small price compared to the tens of thousands you could save in taxes. Let me repeat that. Spending $2,000 to update your estate plan could save your family $99,600 or more in state taxes. That's a conservative, safety-first approach that protects your principal and your legacy. So, to summarize, the practical implementation of state tax optimization comes down to 5 steps. Map your income, review your state's tax rules, build a withdrawal plan, verify your residency, and coordinate your estate plan. Each step builds on the last, and together they can help you keep more of your hard-earned savings. But before you take action, you need to avoid these critical mistakes, because even a small misstep can cost you thousands or derail your entire plan. Let's move on to the most expensive pitfalls retirees face and how you can steer clear of them before it's too late. Part 4: Costly Pitfalls, the Expensive Mistakes that Drain Retirees' Savings. Now that you know the step-by-step process for optimizing your state tax situation, it's just as important to recognize the costly mistakes that can undo all your hard work. In my 30-plus years of guiding retirees, I've seen thousands of well-meaning seniors lose tens of thousands of dollars, not because they were reckless, but because they missed a key detail or fell into a common trap. Let me walk you through the most expensive pitfalls I've witnessed so you can protect yourself and your family from these avoidable setbacks. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation before making any changes to your retirement plan. The first mistake is failing to establish legal residency when moving to a tax-friendly state. Many retirees assume that simply buying a home or spending a few months each year in a state like Florida or Texas is enough to stop their old state from taxing their income. But here's the reality. States like California, New York, and New Jersey are aggressive about keeping retirees on their tax rolls. If you don't take every step to prove your new domicile, such as spending at least 183 days per year in the new state, updating your driver's license and voter registration, moving your primary doctor, and even changing your car insurance, you could be hit with a statutory resident audit. I've seen retirees who thought they'd escaped state taxes, only to be assessed back taxes, penalties, and interest totaling $24,000 over just 3 years. The warning sign? You're still using your old address on key documents, or you haven't updated your legal and financial records in your new state. The second mistake is withdrawing too much from taxable retirement accounts in a single year. Many people, eager to pay off a mortgage or fund a big purchase, take large lump sum withdrawals from their 401k or IRA. The problem? This can push you into a higher state tax bracket, triggering not only higher income taxes, but also increased Medicare premiums, and in some states, taxes on your Social Security benefits. For example, if you take a $50,000 lump sum from your IRA in a state with a 6% income tax, you'll owe an extra $3,000 in state taxes that year. If that withdrawal also bumps your income above the IRMA threshold, you could pay an additional $1,978 per year in Medicare Part B premiums for at least 2 years. Over a decade, that mistake could cost you more than $23,000. The warning sign here is any year where your total withdrawals are significantly higher than your usual income, especially if you're making a one-time large purchase. The third pitfall is ignoring state-specific rules about Social Security and pension taxation. Too often, retirees assume that because federal law exempts Social Security from tax below certain thresholds, their state will do the same. In reality, 13 states still tax Social Security to some degree, and many states have unique rules for pension income. For example, in Nebraska, Social Security becomes taxable once your federal adjusted gross income exceeds $44,460 for couples. In Connecticut, public pensions may be exempt, but private pensions are not. I've worked with retirees who lost $2,000 to $5,000 per year simply because they didn't adjust their withdrawals to stay below critical state thresholds. Over a 15-year retirement, that's $30,000 to $75,000 lost. The warning sign? You notice your state tax bill is higher than expected, or you're surprised by a tax on income you thought was exempt. The fourth and perhaps most heartbreaking mistake is failing to update your estate plan to reflect your current state's tax laws. Some retirees move to a new state but never review their wills, trusts, or beneficiary designations. Others assume that because their estate is below the federal exemption, currently $13.6 million per person in 2024, they're safe. But several states have much lower estate or inheritance tax thresholds. For instance, Massachusetts and Oregon start taxing estates at $1 million, and the rates can reach 16%. If you have $1.5 million in assets and pass away in Massachusetts without proper planning, your heirs could face a $70,800 state estate tax bill, money that could have been largely avoided with a simple trust or lifetime gifting strategy. The warning sign? You haven't reviewed your estate documents in the past 5 years, or you've moved states without updating your legal paperwork. Let me repeat that important point. Just one of these mistakes, whether it's failing to prove your new residency, taking a large lump sum withdrawal, missing a state-specific tax rule, or neglecting your estate plan, can cost you and your family anywhere from $20,000 to over $100,000 across your retirement. These are not rare cases. I see them every year, and they're entirely preventable with a little foresight and the right guidance. It's also important to be on high alert for red flags that signal you might be at risk. If your advisor never brings up state taxes, or if you're relying on outdated information from friends or online forums, you could be missing out on critical savings. If your annual state tax bill jumps unexpectedly, or if you receive a letter from your old state's tax authority, don't ignore it. Act quickly to resolve any issues before penalties pile up. Industry insiders know that the most successful retirees are those who review their tax and estate plans annually, keep meticulous records, and work with advisors who understand both federal and state tax law. They don't leave anything to chance, and they don't assume that what worked last year will work this year, especially as states continue to change their tax codes to close budget gaps. Let's recap what we've covered so far. We've identified 4 of the most expensive mistakes: failing to establish legal residency, making large lump sum withdrawals, ignoring state-specific rules on Social Security and pensions, and neglecting to update your estate plan. We've seen the real-world costs: $24,000, $23,000, $75,000, even $70,800 lost just from these common pitfalls. And we've highlighted the warning signs you need to watch for to avoid falling into these traps. But here's the good news. Once you know what to avoid, you're in a strong position to take advantage of advanced strategies that most people never learn. These are the techniques that the wealthiest retirees use to not only protect their income, but also to grow it, safely, conservatively, and with a focus on long-term security. So what are these advanced strategies? How do you go beyond the basics to truly maximize your after-tax income and leave a lasting legacy for your loved ones? That's just the beginning. Here's where it gets really powerful. Part 5. Advanced Strategies, Maximizing State Tax Savings Like the Wealthy. Now that we've covered the most common and expensive mistakes, you're already ahead of most retirees. But what truly sets the wealthiest, most secure retirees apart isn't just avoiding pitfalls. It's using sophisticated but surprisingly accessible strategies to squeeze every last dollar of value from their retirement plan. In my 30-plus years of working with affluent seniors, I've seen these advanced techniques turn a good retirement into a great one, often adding $50,000, $100,000, or even more to a family's lifetime wealth. Let's explore 2 to 3 of these methods in depth so you can see how they might fit into your own plan. Remember, this is educational content, not personalized financial advice. Every retiree's situation is unique, and you should always consult with a qualified financial advisor before implementing any advanced strategies. The first advanced technique is Roth IRA conversions, timed for maximum state tax efficiency. Many retirees know about Roth conversions at the federal level, but few realize the dramatic impact that timing and location can have on state taxes. Here's how it works. When you convert funds from a traditional IRA or 401k to a Roth IRA, you pay income tax on the converted amount. But if you plan your conversion during a year when you are a resident of a state with no income tax, like Florida, Texas, or Nevada, you could save thousands compared to converting while still living in a high-tax state. For example, let's say you have $250,000 in a traditional IRA and you're considering converting $50,000 per year over 5 years. If you do this while living in California, you'll pay up to 9.3% in state income tax on each conversion, $4,650 per year, or $23,250 over 5 years. But if you establish legal residency in Florida before starting your conversions, your state tax bill drops to zero, saving you the entire $23,250. That's money you keep in your Roth, growing tax-free for you and your heirs. The most successful retirees I work with often plan their move and their Roth conversions together, sometimes even delaying their conversion by a single year to take advantage of a more favorable tax environment. Industry insiders know this state arbitrage is one of the best-kept secrets for reducing lifetime tax liability. Let me repeat that. Simply timing your Roth conversions to coincide with a move to a no-tax state can add tens of thousands of dollars to your after-tax retirement savings. The second sophisticated strategy is income bunching and strategic withdrawal sequencing to manage both state income taxes and Medicare premiums. Many states have progressive tax brackets, meaning your rate increases as your income rises. By carefully controlling the amount you withdraw from taxable accounts each year and pairing this with tax-free withdrawals from a Roth IRA or qualified HSA, you can stay below key state tax thresholds, minimize your overall tax bill, and often avoid higher Medicare premiums. Here's a concrete example. Suppose you're a couple living in Minnesota, where state tax rates jump from 5.35% to 6.8% once your taxable income exceeds $98,760. If you need $80,000 per year, you might take $40,000 from your IRA and $40,000 from your Roth IRA, keeping your taxable income below the higher bracket. If you need to make a large purchase, you could bunch your withdrawals into a single year when your income is already high, perhaps when selling a property or receiving a one-time pension payout. Then draw less in subsequent years to stay in a lower bracket. Over a 10-year retirement, this method can save between $15,000 and $25,000 in state taxes and Medicare surcharges. Another way to optimize is by using qualified charitable distributions, QCDs, from your IRA. If you're age 70 and a half or older, you can direct up to $100,000 per year from your IRA directly to a qualified charity. These distributions count toward your required minimum distribution, RMD, but are excluded from your taxable income at both the federal and, in most cases, state level. This can help you avoid crossing into higher tax brackets or triggering state taxes on Social Security. For example, if you normally donate $10,000 per year to charity, making that gift as a QCD could save you $500 to $1,000 per year in state taxes, depending on your state's rules. Over a decade, that's $5,000 to $10,000 in direct savings, plus the satisfaction of supporting causes you care about. The third advanced strategy is state-specific trust and gifting techniques for estate tax reduction. As we discussed earlier, some states have estate or inheritance taxes with thresholds as low as $1 million. If your estate is close to or above this limit, you can use a combination of irrevocable trusts, lifetime gifts, and beneficiary designations to minimize or even eliminate state estate taxes. For example, in Massachusetts, the estate tax starts at $1 million and can reach 16%. If you have $1.5 million in assets, your heirs could face a $70,800 tax bill. But by setting up an irrevocable life insurance trust, ILIT, or making annual gifts of up to $18,000 per recipient, as allowed in 2024, you can gradually reduce your taxable estate below the threshold. The wealthiest retirees I've advised often start this process in their early 60s, giving themselves a decade or more to move assets out of their estate. With careful planning, it's possible to save your heirs $50,000, $100,000, or even more, money that stays in your family rather than going to the state. It's important to note that these advanced strategies require coordination and timing. For Roth conversions, you need to ensure you've established residency in the new state before making the conversion. For income bunching and sequencing, you'll want to project your income and withdrawals 2 to 3 years in advance. For trusts and gifting, you may need to start several years before reaching the estate tax threshold to fully realize the benefits. Let me pause for a moment and emphasize, these are not risky maneuvers or loopholes. Each technique is backed by decades of tax law and is used by the most conservative, security-minded retirees. The difference is, most people never hear about them because they require a little extra planning and a willingness to look beyond the basics. But the results speak for themselves. $23,250 saved on Roth conversions, $15,000 to $25,000 from smart withdrawal sequencing, $50,000 or more in estate tax reductions. That's the power of advanced state tax optimization. And don't forget the added benefit. Many of these strategies also reduce your risk of audit, as they're well documented and fully compliant with both federal and state law. In fact, the IRS and state tax agencies encourage proactive planning because it helps retirees avoid costly mistakes and ensures everyone pays only what's legally required. No more, no less. So far, we've explored 3 advanced techniques: timing Roth conversions for state tax savings, using income bunching and withdrawal sequencing to minimize both state taxes and Medicare premiums, and employing state-specific trusts and gifting to reduce estate taxes. Each of these can be tailored to your specific circumstances, and when combined, they create a powerful, multi-layered approach to protecting and growing your retirement wealth. But here's the key. The timing and sequence of these strategies are critical. Implementing them in the right order and at the right time can make the difference between saving a little and saving a fortune. The most successful retirees I work with always start with a timeline, mapping out exactly what to do in the next 30, 60, and 90 days, and then reviewing their plan every year as laws and circumstances change. The key to success is getting your timing exactly right. So, how do you build a clear, step-by-step timeline for implementing these strategies? What should you do first, second, and third to maximize your results and avoid unnecessary risk? Let's break down the implementation timeline so you can put these powerful techniques to work for you. Part 6. Your 90-day action plan, sequencing state tax optimization for maximum results. Let's turn all these advanced strategies into a clear, step-by-step action plan. In my 30-plus years working with retirees, I've learned that the difference between good intentions and real results almost always comes down to having a timeline you can follow. Wealthy retirees don't just know what to do, they know exactly when to do it and in what order. That's how they maximize every opportunity, avoid costly missteps, and sleep better at night knowing their finances are secure. Remember, this is educational content, not personalized financial advice. Your situation is unique, and you should always consult with a qualified financial advisor before acting on these steps. Let's break your state tax optimization journey into the next 90 days. This isn't about rushing. It's about making steady, confident progress. I recommend you approach this as a series of manageable milestones, each one building on the last. The first 30 days, assessment and discovery. Your first month is all about gathering information and laying the groundwork. Start by collecting statements for every source of income you'll have in retirement: Social Security, pensions, IRAs, 401ks, Roth IRAs, taxable brokerage accounts, annuities, and any other assets. Write down the exact monthly or annual amounts for each. For example, you might list $2,900 per month from Social Security, $15,000 per year from a pension, $20,000 per year from IRA withdrawals, and $8,000 per year from dividends. Next, review your current state's tax rules for each type of income. Most state revenue department websites provide clear charts or calculators. Pay special attention to whether your state taxes Social Security, the brackets for taxing retirement account withdrawals, and any estate or inheritance tax thresholds. If you're considering a move to a more tax-friendly state, this is the time to research residency requirements. For example, Florida requires you to spend at least 183 days per year in the state, obtain a Florida driver's license, and register to vote there. Mark these requirements on your calendar. By day 30, you should have a complete tax map for your situation. What's taxed, what's not, and where your biggest risks and opportunities lie. This is the foundation the wealthiest retirees use to make smart decisions. Days 31 to 60. Planning and professional consultation. With your income and tax map in hand, your next step is to create a draft withdrawal plan for the coming year. Decide, based on your state's tax brackets, how much you'll take from each account. For example, you might choose to withdraw $12,000 from your 401k and $8,000 from your Roth IRA to keep your taxable income below a key threshold. If you're considering a Roth conversion, estimate the amount and note the tax impact if you do it in your current state versus after establishing residency in a no-tax state. This is the ideal time to schedule a meeting with a qualified financial advisor and, if possible, a tax professional who understands state-specific rules. Bring your income map, your draft withdrawal plan, and any questions about moving or gifting assets. Ask them to help you stress test your plan for the coming year and for the next 5 years. For example, ask, if I do a $40,000 Roth conversion after moving to Florida, how much will I save in state taxes compared to doing it before I move? Or, if I withdraw $5,000 less from my IRA, will it keep me under the threshold for state Social Security taxation? If you're updating your estate plan, contact your attorney now. Many states require certain documents to be notarized or filed with the court. If you want to set up a trust, the process can take several weeks. Mark deadlines on your calendar, such as a goal to have all estate documents updated within 60 days. By day 60, you should have a professionally reviewed, tax-efficient withdrawal plan, a clear understanding of residency requirements if you're moving, and a timeline for updating your estate documents. Days 61 to 90. Implementation and adjustment. The final month is about taking action and adjusting as needed. Begin executing your withdrawal plan, making sure to document each transaction. If you're establishing residency in a new state, complete all required steps, spend the necessary number of days, update your driver's license, register your car, and open a local bank account. Keep receipts and records, as some states may audit your residency status. If you're doing a Roth conversion, make sure it's processed in the correct tax year and after your new residency is established, if you're moving. For qualified charitable distributions, contact your IRA custodian to arrange direct transfers to your chosen charities. Remember, QCDs must go directly from your IRA to the charity to qualify. If you're updating your estate plan, review the new documents carefully and ensure all beneficiary designations are coordinated with your will and trusts. If you're gifting assets, document each gift and keep records for tax purposes. Throughout these 90 days, keep an eye on key deadlines. For example, if you want your new residency to count for the current tax year, most states require you to complete all steps by December 31st. If you're planning a Roth conversion, remember that it must be completed by December 31st to count for that tax year. Estate documents should be finalized before any major health events or travel. After 90 days, schedule a follow-up with your advisor to review your progress and make adjustments. The most successful retirees I work with revisit their plan at least once a year, especially if tax laws or their personal circumstances change. Let me repeat that. A 90-day action plan with specific milestones for assessment, planning, and implementation can be the difference between losing tens of thousands to unnecessary state taxes and keeping that money in your family. Every month you delay can cost you $500, $1,000, or even more in lost savings or missed opportunities. So far, we've outlined a clear timeline: 30 days for assessment, 30 days for planning with professionals, and 30 days for implementation. Each step is designed to build your confidence, reduce your risk, and maximize your after-tax retirement income. But even with the best plan, real life has a way of throwing curveballs. What if you hit an unexpected roadblock? What if your state changes its tax laws mid-year, or you face a health crisis that changes your withdrawal needs? The truth is, even the most carefully crafted plans need troubleshooting from time to time. Even if you follow this perfectly, you might encounter these common roadblocks, and knowing how to solve them is the next key to your financial security. Part 7. Troubleshooting and Problem Solving. Overcoming the roadblocks to state tax optimization. Even with a solid 90-day plan, life sometimes throws a wrench into your best-laid strategies. In my 30-plus years of helping retirees navigate the complex world of tax optimization, I've seen how unexpected challenges can pop up, often at the worst possible time. The most successful retirees aren't the ones who never face problems. They're the ones who know how to adapt, troubleshoot, and get back on track without risking their financial security. Let's walk through some of the most common roadblocks you might encounter and the proven solutions I recommend to keep your plan moving forward. And as always, this is educational content, not personalized financial advice. Every situation is unique, so consult with a qualified financial advisor for your specific needs and circumstances. One of the most frequent challenges is a sudden change in state tax law. Imagine you've spent months preparing to move to a tax-friendly state, maybe Florida or Nevada, only to discover that your current state has tightened its residency rules or the new state has changed how it taxes retirement income. This happens more often than you might think. For example, New York and California have both increased residency audits in recent years, and states like Nebraska and Colorado have adjusted how they tax Social Security and retirement distributions. If you find yourself in this situation, don't panic. The first step is to review the new rules with your advisor and document every action you've taken to establish residency. If your state is challenging your move, gather proof: travel receipts, utility bills, voter registration, and even photos of you in your new home. Industry insiders know that the most successful retirees keep a residency file with at least 12 months of supporting documents. If the new state suddenly changes its tax treatment of retirement income, you may need to adjust your withdrawal strategy for the current year. For instance, you might delay a Roth conversion or shift more withdrawals to a Roth IRA if those are still tax-free. The key is to stay flexible and respond quickly rather than sticking to a plan that no longer fits. Another common challenge is unexpected healthcare expenses or a sudden increase in income that pushes you into a higher state tax bracket or triggers higher Medicare premiums. Let's say you have an unplanned hospital stay or you sell a property and realize a large capital gain. Suddenly, your income for the year jumps by $40,000, putting you over the IRMA threshold and into a higher state tax bracket. This could mean an extra $1,978 per year in Medicare premiums, plus $2,400 or more in additional state taxes. Here's how to respond. First, if you have a health savings account, HSA, consider using those funds to pay for medical expenses tax-free, which won't increase your taxable income. Second, if you can, time any additional withdrawals or sales to spread the income over 2 tax years, selling half in December and half in January, for example. Third, if you're hit with higher Medicare premiums due to a one-time event, like selling a home or taking a large IRA withdrawal, you can file an appeal with Social Security using Form SSA 44, explaining that the increase was due to a life-changing event. Many retirees are surprised to learn that these appeals are often successful, reducing your premiums back to normal levels. A third roadblock is incomplete or outdated estate planning, especially after a move. It's all too common for retirees to move to a new state, update their driver's license and voter registration, but forget to revise their wills, trusts, and beneficiary designations. This can lead to serious problems, assets passing to the wrong heirs, state estate taxes that could have been avoided, or even lengthy probate battles. If you realize you've overlooked this step, act quickly. Contact an estate planning attorney licensed in your new state and have them review your entire plan. Make sure your will, powers of attorney, healthcare directives, and any trusts comply with local law. Update all beneficiary forms for IRAs, 401ks, and insurance policies to reflect your new residence. In my experience, making these updates within 60 days of your move can prevent 99% of the problems I've seen with out-of-state documents. Let's also address a what-if scenario I hear often. What if you discover a mistake in your tax filings from a previous year, such as claiming residency in 2 states or failing to report a Roth conversion correctly? First, don't ignore it. The sooner you address the error, the lower the risk of penalties and interest. Most states allow you to file an amended return within 3 years. Gather your documents, consult your advisor or CPA, and file the correction as soon as possible. In many cases, I've seen retirees reduce their penalties by 50% or more simply by being proactive and transparent with the tax authorities. Another common scenario is the need to help adult children or grandchildren financially, perhaps with a home down payment, education costs, or unexpected emergencies. Large gifts can have state tax consequences, especially in states with low estate or inheritance tax thresholds. The solution? Use annual gift exclusions, currently $18,000 per recipient in 2024, to spread gifts over several years, or explore setting up a 529 plan for education savings, which can have state tax benefits. Always document your gifts and consult your advisor to ensure you don't inadvertently trigger a gift tax or reduce your own financial security. Let's recap what we've covered so far. We've addressed how to handle sudden changes in state tax law, unexpected spikes in income or health care costs, outdated estate planning after a move, tax filing mistakes, and the financial needs of family members. In each case, the solution is to stay informed, act quickly, and consult with professionals who understand both state and federal rules. The most successful retirees I've worked with always keep detailed records, review their plans annually, and aren't afraid to ask questions or seek help when something changes. Let me repeat that. Troubleshooting is not about perfection. It's about resilience and adaptability. Every retiree faces curveballs, but with the right mindset and a trusted team, you can turn challenges into opportunities to protect and even grow your retirement wealth. So far, you've built a strong foundation, avoided the most common mistakes, and learned how to troubleshoot the inevitable bumps in the road. Once you master this foundation, you're ready for the next level, where you can truly optimize, scale, and future-proof your retirement plan as your needs and the world around you evolve. Once you master this foundation, you're ready for the next level, where we'll explore advanced actions for maximizing your results, scaling your strategy, and making sure your plan stands the test of time. Part 8. Next Level Actions and Optimization. Maximizing, scaling, and future-proofing your state tax strategy. If you've followed along this far, you've already put yourself in the top tier of American retirees, those who understand not just the basics of state tax optimization, but also the importance of timing, troubleshooting, and annual review. But what truly sets the wealthiest, most resilient retirees apart is their commitment to continuous improvement. They know that tax laws, family needs, and financial markets are always changing, and they're willing to go beyond the basics to protect and grow their wealth for the long haul. Let me be clear. This is educational content, not personalized financial advice. Every retiree's situation is unique, and you should always consult with a qualified financial advisor to tailor these advanced strategies to your specific needs and goals. So, what does next level look like? In my 30-plus years helping seniors with substantial retirement savings, I've seen 3 key areas where advanced actions can make a 6-figure difference over time: dynamic withdrawal strategies, multi-state planning, and legacy optimization. Let's start with dynamic withdrawal strategies. Most retirees use a set-it-and-forget-it approach, taking the same amount from the same accounts each year. But the most successful retirees I work with treat their withdrawal plan like a living document. Every year, they review their income needs, tax brackets, and state laws. For example, if a state raises its tax on retirement income, they might temporarily increase Roth IRA withdrawals to minimize taxable income. If investment returns are strong one year, they might take more from taxable accounts, preserving tax-advantaged accounts for future years. This flexibility can save between $3,000 and $10,000 per year in state taxes and Medicare premiums, adding up to $60,000 or more over a 20-year retirement. Another advanced move is tax bracket harvesting. This means intentionally filling up lower state tax brackets each year with IRA withdrawals or Roth conversions, so you don't leave valuable low-tax space unused. For instance, if your state's 3% bracket ends at $40,000 of taxable income and you're only taking $30,000, you might convert an extra $10,000 from your IRA to a Roth IRA. This ensures you pay the lowest possible rate on those dollars, and future withdrawals from the Roth will likely be state tax-free. Over time, this careful harvesting can dramatically reduce your lifetime tax bill. Next, let's talk about multi-state planning. Many affluent retirees split their time between 2 or more states, perhaps summering in Michigan and wintering in Florida. The key is to understand the 183-day rule for residency and plan your travel and documentation accordingly. But next-level retirees go further. They coordinate charitable giving, large purchases, and asset sales to occur while they're legal residents of the most tax-friendly state. For example, selling a highly appreciated property while domiciled in Florida could save $20,000 or more in state capital gains tax compared to selling in New York. If you're considering a major Roth conversion, you might schedule the conversion for a year. You qualify as a resident of a no-tax state, locking in those savings for decades to come. Industry insiders also know that some states offer unique tax credits or deductions for seniors, such as property tax circuit breakers, retirement income exclusions, or credits for long-term care insurance premiums. The most successful retirees review these benefits every year and adjust their spending or investment plans to maximize their eligibility. For example, in Pennsylvania, retirees over 65 may qualify for property tax rebates of up to $1,000 per year, while in Arizona, certain retirement income is partially exempt from state tax. These programs change frequently, so annual review is essential. Now let's address legacy optimization. As you age, your priorities may shift from maximizing your own income to preserving wealth for your children or grandchildren. Advanced estate planning can help you minimize or eliminate state estate and inheritance taxes, ensure your assets pass quickly and smoothly to heirs, and even support charitable causes you care about. One powerful technique is the Family Limited Partnership, or FLP, which allows you to transfer ownership of real estate or business interests to heirs at discounted values, reducing both state and federal estate taxes. Another is the Dynasty Trust, available in some states, which can shield assets from estate taxes for multiple generations. If you have a blended family, grandchildren with special needs, or a desire to support charity, a qualified charitable remainder trust, CRT, can provide income for you during your lifetime, a tax deduction up front, and a legacy for your chosen cause. These advanced trusts require careful planning and professional guidance, but they're used by many of the wealthiest retirees I've advised to keep their family's financial future secure. Don't forget to factor in long-term care and health care planning as part of your optimization strategy. Many states offer tax deductions or credits for long-term care insurance premiums or for out-of-pocket medical expenses. By coordinating your withdrawals and health care spending, you can often reduce your taxable income enough to qualify for these benefits, saving $2,000 to $5,000 per year, depending on your state and your health care needs. A critical long-term consideration is the impact of inflation and changing tax laws. The most resilient retirees build what-if scenarios into their plans, stress-testing their withdrawal strategies and estate plans against the possibility of higher state taxes, new taxes on retirement income, or changes in Social Security taxation. For example, if your state is considering a new tax on 401k withdrawals, you might accelerate Roth conversions or consider partial relocation before the law takes effect. If inflation pushes you into a higher bracket, you can adjust your withdrawal mix to keep your after-tax income stable. Let me recap what we've covered so far. Next-level optimization means reviewing and adjusting your withdrawal plan every year using tax bracket harvesting to fill low-tax space, coordinating asset sales and charitable gifts with your state residency, maximizing state-specific credits and deductions, and proactively updating your estate plan to reflect changing goals and laws. It means thinking not just about this year, but about the next 5, 10, or even 20 years, and being ready to pivot as your needs and the world evolve. In my experience, the wealthiest and happiest retirees are those who treat their tax and income plan as a living document. They don't just look for one-time savings, they build a habit of annual review, professional consultation, and family communication. They stay informed about state and federal law changes, and they're willing to make strategic adjustments when opportunities or risks arise. Let me repeat that. The most successful retirees don't just react to tax changes, they anticipate them, and they're ready with a plan that puts their family's needs and goals first. So, as you move forward, ask yourself, are you ready to take your retirement plan to the next level? Are you prepared to review, optimize, and future-proof your strategy every year so you can keep more of your hard-earned savings and leave a lasting legacy for those you love? That's just the beginning of what's possible. In our next session, we'll explore the most important mindset shifts and habits that separate the truly secure retirees from those who are always playing catch-up, and reveal how you can build a lifelong system for financial peace of mind, no matter what the future holds. Over the past hour, we've covered a tremendous amount of ground on the topic of state tax optimization for retirees. Let's take a moment to reflect on the journey you've just taken. We began by identifying the hidden dangers of state taxes and how they can quietly erode your retirement savings, sometimes by $70,000, $100,000, or more over the course of your retirement. We explored the core solution, understanding your state's unique tax laws, creating a tax-smart withdrawal plan, and aligning your estate strategy. You learned 5 practical steps for implementation, from mapping your income sources to coordinating your estate plan, and we reviewed the most common and expensive mistakes that can drain your wealth, like failing to establish residency, making poorly timed withdrawals, or neglecting to update legal documents. We then delved into advanced strategies such as timing Roth conversions, income bunching, and state-specific trusts before mapping out a clear 90-day action timeline. We also tackled troubleshooting, showing you how to adapt if tax laws change or unexpected events disrupt your plan. Finally, we looked at next-level actions, dynamic withdrawal strategies, multi-state planning, and legacy optimization, ensuring your plan evolves as your life and the law change. The knowledge you've gained today could easily save you tens of thousands, if not more, over your lifetime. This isn't just entertainment, it's valuable financial education distilled from decades of experience working with retirees just like you. What separates financially secure retirees from those who struggle is usually knowledge and implementation, and you've just taken a major step forward. Now that you understand each piece, here's how they work together to create a truly comprehensive state tax optimization strategy. When you combine proactive income mapping, state-specific withdrawal planning, timely residency moves, and coordinated estate planning, you create a compound effect that goes far beyond what any single tactic can achieve. For example, a retiree who maps out income sources, times a $50,000 Roth conversion after moving to Florida, and updates their estate plan to avoid Massachusetts estate taxes could save $23,000 on state income taxes, $70,000 in estate taxes, and thousands more in Medicare premiums and property tax credits. That's a 6-figure difference, money that stays in your family, funds your dreams, and protects your legacy. This is why wealthy retirees often outperform those who started with more capital but failed to optimize. The most successful clients I've worked with consistently apply these principles, reviewing their plans every year, staying informed about law changes, and working with qualified professionals to fine-tune their approach. After helping retirees navigate multiple market cycles, I can tell you, the real advantage comes from integrating all these elements into a single, adaptable system. So, what should you do next? Here are the specific steps you can take in the next 30 days to start putting this knowledge to work. Step 1. Assessment phase, first week. Start by gathering 3 essential documents: your most recent Social Security statement, your latest tax return, and a summary of all retirement accounts, IRAs, 401ks, pensions, brokerage accounts. Use a simple spreadsheet or notebook to list each income source and its annual amount. Calculate your total projected income for the next year and note which types are taxed by your state. Identify your biggest opportunity area, whether that's high state taxes on IRA withdrawals, Social Security taxation, or a looming estate tax threshold. Step 2. Planning phase, second week. Create your personalized timeline based on your age, income needs, and any plans to move or downsize. Research the specific options we discussed that apply to your situation, like Roth conversions, qualified charitable distributions, or state-specific credits. Document your current withdrawal and estate plan and compare it to what you've learned. Where are you exposed? Where could you save more? Step 3. Professional consultation, third week. Schedule a meeting with a qualified financial advisor and, if possible, a tax professional who understands your state's laws. Bring your income map, your timeline, and a list of questions. How can I minimize my state tax bill based on my current income mix? If I move, what specific steps are needed to establish residency? What's the best way to update my estate plan for my new state? Verify that your advisor understands these advanced strategies and is proactive about ongoing state law changes. Step 4. Implementation begins, 4th week. Start with the lowest risk, highest impact change first, perhaps adjusting your withdrawal sequence or setting up a Roth conversion in a tax-friendly year. Set up the systems and accounts needed for your new strategy, like updating bank accounts for residency or establishing a trust. Begin tracking your progress with simple metrics: annual state tax paid, Medicare premiums, and projected estate tax exposure. Small improvements now can compound into major savings over time. Step 5. Annual review and adjustment. Mark your calendar for an annual review each year, ideally after tax season or when state budgets are announced. Revisit your income sources, tax laws, and estate plan with your advisor. Adjust your withdrawal mix, residency status, and legal documents as needed. This habit alone is a hallmark of the most financially secure retirees. Remember, every financial strategy carries some level of risk, and tax laws can and do change. The goal isn't perfection, it's optimization based on your unique situation. Most successful retirees implement these changes gradually over 6 to 12 months, not all at once. Don't let perfectionism prevent you from starting with small improvements. These aren't get-rich-quick schemes. They're proven, long-term strategies that protect your principal and your peace of mind. The cost of inaction often exceeds the cost of making imperfect but informed decisions. Most retirees' biggest regret is waiting too long to optimize their strategies. And while you don't need to rush into major decisions, gathering information and starting your planning should happen soon. You now have knowledge that many retirees never acquire. Use it to your advantage. You're now part of a community of informed retirees who refuse to settle for average results. The journey to financial optimization is ongoing. Markets change, laws evolve, and so do your goals. Continue your education by staying informed about retirement planning developments, and don't hesitate to share your success stories or lessons learned. Your experience could help others in this community avoid costly mistakes and build a stronger legacy. If you've implemented any of the strategies discussed, share your experience in the comments. What worked for you, and what would you do differently next time? If you're facing a unique challenge, ask your question here. Chances are, someone else in our community has faced it too. If this video helped clarify your retirement planning strategy, please give it a thumbs up. Share your biggest takeaway in the comments. Which strategy will you implement first? Subscribe for more in-depth retirement guidance that could save you thousands or even hundreds of thousands over your lifetime. Most importantly, take action on what you've learned. Your future self and your family will thank you. And let me emphasize, while this information provides a strong foundation, professional guidance is invaluable. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial and tax professionals before making significant changes. Past performance of any strategy doesn't guarantee future results, and the tax implications we discussed may change based on future legislation. Tax professionals can ensure you're maximizing benefits while staying compliant. Estate planning attorneys can help with the legal aspects we covered. In my decades of helping retirees optimize their finances, I've seen that knowledge and implementation, not luck, are what separate those who thrive from those who struggle. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances. Picture the impact your wise decisions will have on your children, grandchildren, and the causes you care about. You've worked too hard to accept anything less than optimal planning. Maintain your independence by taking control of your financial destiny and leave a legacy that reflects your wisdom and experience. You'll know you're on the right track when your financial stress decreases and you have clear answers to the questions that used to keep you awake. Remember, the goal is progress, not perfection. Small improvements compound over time. Measure your success by your increased confidence and clarity. So, what surprised you most about the strategies we covered today? Which approach best fits your current situation? Have you already implemented any of these tactics? Share your experience below. What's your biggest concern about retirement planning that we should address next? If you could ask a financial advisor one question based on this session, what would it be? Thank you for investing your time and attention. Take action, stay informed, and remember, optimizing your state taxes isn't just about saving money, it's about securing your future and your legacy. Your journey to a more secure and empowered retirement starts now.